To be a consistent, profitable trader, you actually need two specific things in place. One is you need to have a trading model. So a model, certain strategy that works for you. And you know the data of, you know the win rate, you know when it works, when it doesn't work. The second thing you need to know is what kind of trader are you? Are you a scalper? So are you taking like small, on a time scale, small trades, so meaning within an hour and you're out? Are you an intraday trader? So you take a trade from maybe an hour or a couple of hours? Or are you a swing trader that takes trades that even hold overnight? What if you could find like a model that works on every time frame, so for every type of trader, intraday, scalper, swing, because it's a fractal model. And today I want to go over in this video one of the most common ICT models and how you can apply those depending on what kind of trader you are. So I'm going to take one model and explain how you could take this specific model as a scalper, how you can take this specific model as an intraday trader, and how you can take this specific model as a swing trader. So let me dive into it. I'm going to take one of the most common ICT, let's call it a pattern, most common ICT ways to trade. And that is this specific picture. You've probably seen loads of times. If you see it for the first time, I'm going to explain it. ICT, one of his signature things is that you train yourself to look for the accumulation phases. So where price is just going back and forth and creating a range. Then the manipulation phase, making everyone believe in this case that the order flow is bearish. And then coming out of that, creating a market structure shift and starting a distribution leg up. We've all seen this picture, right? But how to make this super practical and apply this to the charts and to your own trading? Well, if we look at this specific signature model, if we remove the accumulation, manipulation, distribution, it's all around liquidity. So the most important thing is that you start recognizing, first of all, the liquidity points. So meaning the top of the range is building liquidity and the lower side of the range has been building liquidity. And one side of the range get rated, so we get a liquidity rate, and it then targets the other side of the range. This specific thing in here is also called a market make buy model, but doesn't even matter. So how can we apply this now to the type of trader you are? Because I believe that every trader, every scalper, every intraday trader, and every swing trader can trade this model. However, a model needs rule sets, right? So we cannot just randomly go into the charts on some random timestamp and look for it. We need to have a certain framework because in the end, this model you see here is and we see price points, but we need to place this in time. So of course we have the axis here. So these are the price points, lower, higher, but we also have this X, which is the time X. So how can we make a high probability model from this when you're a scalper? Well, let me put on my scalping lipstick. A scalper could trade it like this. We have a range forming in Asia. So the first part of the daily candle, this is Asia. If you see, and you just need to go over your charts, of course, because it won't form every day. It's not like a model you trade every day on the same chart. However, if you would put on multiple charts, you can just look for where did Asia form a range. And then you want to mark out the Asia low and the Asia high. So the same thing as I was just pointing out, but now we've put some time-based liquidity points on the chart. So now it gets some more like strategy and structure around it. So what we see is that we have an Asia range, and when we open in London, we get a raid of the Asia low, and then we get that signature model to get into and target the Asia high. A lot of the times this is a trade between like 5 or 1 hour, 5 minutes or 1 hour, and then you're done. This is a scalp play for the scalper, if we would put this time framework around it. So that means that London in this case is a kill zone between 2 a.m. and 5 a.m. Somewhere in here we want to see that low form and then get that reversal play. Is this bias daily bias based? Yes, can be, doesn't have to. This can be a bullish day, this can be a bearish day. Why? Because sometimes if this was a bullish day, we only see the rate of the low and then we start distributing higher. However, what you also a lot of the time see, if this is a bearish day, you first get a rate of the low, then a rate of the high, and then it starts coming down again. So that's double purge. That's not relevant for this model. What we see over here is the scalper's way of looking for the accumulation, then a manipulation lower, and then a distribution leg to the opposite side of the range. So scalping. But what if we are not a scalper? We just want to trade intraday, keep it cool, keep it relaxed. Well, then what we can do is we take intraday time framework around this. So an intraday framework is this. And now you will see some similarities. Because what is the Asia range on a daily basis, on a daily candle? It's the first 6 hours of the daily candle forming. So an intraday player, intraday trader, what can we do? Well, our range is not Asia, but Monday, the entire price action of Monday. And what we then do is then on Tuesday, we look for a raid, in this case of the Monday low liquidity, look for that reversal play throughout the day to target Monday high. This is an intraday play you look for on the specific Tuesday. Sometimes Tuesday accumulates and we get the Wednesday rate of liquidity, and then on Wednesday it starts running for that Tuesday high. So this can apply on more days than only Monday, but a lot of the times it forms on Monday. Just like a lot of the times it forms on Asia. Sometimes London accumulates, then we can get this play in New York. But if we just keep it simple, look for one model, I would look for this Monday range, Tuesday raid, trade it to the opposite high. This is the trade. You're not holding it. You just take your entry model here, stop below the low, and you target the high, and you're done. That's it. So this is how you can trade the exact same thing in price action, but on a higher time frame, intraday. And of course, there's a swing approach to this. So how would we put on a time-based swing approach on the same model? Well, we can do that by doing it this way. Meaning, we're not looking for the Asia being the first range of the day. We're not looking for Monday being the first range of the week. No, we're looking for week 1 of an entire month. So the range that forms in week 1 of the month, if that month was a range, of course, we only look for ranges. If this expands, it's not this model. So ranges. If week 1 is a range, you want to look for a raid of that weekly low in week 2, somewhere in week 2. And then you'll trade it back up to the high. And this can take multiple days before it comes back to that weekly high. So this is weekly low to weekly high. The intraday play is Monday low to Monday high. The scalp play is Asia low to Asia high. It's the same model, but it's fractal if you do it like this. But you need to get the timings right, because otherwise it becomes a lower probability way to look for your trade. So I hope this helps, that you can have just one model, but then decide what kind of trader are you? Are you more of an in and out trader, or do you want to be super relaxed and just take one trade a week and you look for the chart that accumulated in week 1 of the month and you take the trade and that's it? That's also possible. But you need to know what kind of trader you are, what makes you confident, and what gives to you at least the high probability setups. And that's it. One model, different type of trader. Just make it easy. That's it for now. Short video, but I hope this was helpful. See you in the next one. Bye bye.